Hello everyone. The financial year 2018, which began start of April, has not really begun on a great note from a fixed income standpoint, both at the short end and the long end of the yield curve. Basically, the small respite that the markets got at the longer end with respect to a reduced borrowing program and a lightened calendar from a central government perspective got to some extent neutralized with a reasonably loaded state government borrowing calendar, which is why the long end of the yield curve, including the state loans, have actually inched up. As we speak, the 10-year benchmark government security yield is at about 7.75%, and the state government yields of similar maturity are at about 8.2 to 8.3%. Not only that, even the short end of the yield curve is witnessing a little bit of tightness, and therefore what usually is a phenomena of March, where we see yields, especially the short end, going up and then receding or easing in the month of April, does not seem to have materialized in the month of April 2018. Key reasons: one, there is this continuous rise in yields globally, specifically the United States, where the 10-year US Treasury has almost touched 3%. And specifically more from a short end at our end, there is a liquidity tightness, probably a combination of dollar rupee weakness and or the liquidity in the banking system skewed towards a few players. Net, the month of April, we believe, has been a mixed bag, specifically even at the shorter end, where yields have risen almost by 15 to 25 basis points. Very recently, there was an announcement on the FPI, or the foreign portfolio investment limits, where there has been earlier the foreign investors had to invest in minimum 3-year residual maturity, both in government bonds as also corporate bonds. Now that limit has been done away with, which means that foreign investors can buy government bonds of any maturity and corporate bonds of minimum 1-year maturity. This, we believe, is a very positive sign which will help some stability at the shorter end of the yield curve. We could expect at least a 25 to 35-40 basis points rally at the short end of the yield curve. What happens to the longer end? Well, that, as I said, is a function of maybe incremental foreign investor buying or public sector bank buying, both of which are absent in the market for now. So what should be the outlook, or what is the outlook going forward? I think very clearly the minutes of the monetary policy meeting has not indicated a very positive way for rates ahead. In fact, there were some of the members talking about potential withdrawing of accommodation if required in the months by. Therefore, the upcoming monetary policy event, which is slated for the month of June, will be a very keen event to watch out for from a bond market perspective. We believe it may be just too soon to withdraw an accommodative bias as yet, given that the inflation parameters seem to be fairly manageable at the current juncture. Crude oil prices definitely could be a joker in the pack, which need to be watched out for. What therefore should be the strategies that investors should focus on in this kind of a scenario? I think there is no obviously marks for guessing that our preference still lies at the shorter end of the yield curve, which means a combination of accrual strategies which are high on yields or YTMs, predominantly with corporate bonds, and a combination of short-term funds which have a duration in the range of 1.5 to about 2.5 years. This, we believe, will allow for a small capital gain as and when the yields start easing, and more importantly, offer a stability on your fixed income portfolio. As yields start inching up at the longer end, we believe that duration strategies could start looking attractive. Therefore, small, I would say, tail end allocations to duration funds like gilt and bond, rather dynamic bond funds, would not be a bad strategy, but in a staggering manner. Bottom line, to conclude, the bond markets definitely are high on volatility at this point in time, mimicking both domestic macro events as also global factors. It is important to stay the course, keep in mind your investment tenure, and therefore stay invested. On that note, happy investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.